Amazon's latest announcement just isn't a warning. As you're about to see, it's a countdown to something unimaginable. Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, don't say we didn't warn you, as Amazon has just issued a dire warning that signals the unthinkable is about to unfold. But this just isn't going to impact big tech companies. As you're about to see, it's also going to impact every American household. And while stocks are crashing today, our tariff trade is soaring. Our subscribers are cashing in big. Stay tuned to the end of the show to learn how you can join the winning side. Now let's head over to CNBC, where we picked today's story up, because this isn't just about big tech. It's about the U.S. consumer. And as you're about to find out, their confidence is crashing. And for the market and for a lot of companies, that's the worst possible sign. As Amazon issues disappointing revenue forecasts, it's about to get much worse and points to the weakest growth on record. And this is a problem because when the big companies like Amazon are saying that revenue is going to be a problem, it all points back to the same thing. That's the U.S. consumer, and that's the labor market. We're going to talk a lot about that here in a bit, but let's take a look at what Amazon's warning about, because they expect sales this quarter to be between 151 and 155 billion, far less than the 158 billion expected. Now keep in mind, we said that analysts were going to set the bar high, and why did they do it? Because they've been selling stocks into retail investors who have been buying big. This is sending Amazon stock down today and pulling the rest of the market with it. But that's not the warning. This guidance anticipates an unusually large unfavorable impact from foreign exchange rates. The impact amounts to 2.1 billion, or 1.5%, and what they're talking about is the dollar. And we've noted that the dollar has been on a tear. It's been very elevated, it's pointing higher, and many expect the dollar to keep moving at an upward pace. Now, if we talk about the impact to companies, we haven't really seen a whole lot of this, but it's starting to show up in earnings now. And even worse, it's going to have a massive impact on the labor market. Let's take a look at what this means for sales as we look at the nominal broad US dollar index in red against inflation adjusted, or what's called real retail sales. That's shown in blue on a year-over-year rate of change. Let's start at 2011. We see the dollar start to move higher, and it has an immediate impact on real retail sales. You can see a deceleration then takes hold before the dollar starts to cool off its trend. But let's move forward to late 2014 as we turn into 2015. What happens? The dollar goes on a massive tear and real retail sales head down. Once again, we see the same effects in around 2018. And look at what's happening right now. Around 2022, the rising dollar finally had an impact on the U.S. economy in the form of real retail sales that have been largely negative for the past 3 years. Right now, even though the dollar's pulled back a little bit, the expectations are it's going to head higher, and you can start to get some perspective here of why analysts are setting the bar so high for American companies, because the rising dollar is going to have an impact, not just on their bottom line, but going forward, we're going to see it have a huge impact on exports and the labor market. The U.S. dollar index, which measures the greenback against a basket of rivals, has hit its highest level in more than 2 years. The dollar climbed steadily from late November through mid-January, and it's fallen a little bit since then. But the problem here that Amazon's saying is, look, this is going to get worse. This is going to have a bigger impact going forward, because right now there's absolutely no signs that the dollar is going to weaken. Now, there's some questions here. Is the dollar rallying because there's a dollar shortage, or is it rallying because of expectations of the global economy slowing? Well, it has everything to do with global trade. Let's take a look at this next chart. As you can see, imports of goods and services in blue, that's shown on a year-over-year rate of change, still against the nominal broad dollar index in red. And let's go to 2011, where we see the dollar start to rally, and has a massive impact on the imports of goods and services, because as you're seeing, the dollar and its strength is not a good sign for U.S. consumers. Many people say it is, but that's not really true, and the evidence is absolutely clear. What do we see? The imports of goods and services decelerate right into a contraction. Then we can move to 2015, where the dollar goes on a tear and has immediate impact on the imports of goods and services. They turn negative. So what we're seeing here is a strong dollar necessarily isn't bad, but a rising dollar for American consumers and the U.S. economy is a terrible thing. And so what Amazon's worrying about is, look, this hit our bottom line this quarter. The problem is it's not getting any better. And when it starts to impact the bottom line of companies, what do? They cut expenses. And what happens when they don't have any more expenses to cut? Well, they cut payrolls. Let's look forward to 2018. We see the dollar once again starts heading higher. Imports go right down as we head into the pandemic. But look then around 2022. Once again, the dollar's taking off, and then it pulls back a little bit, gives some reprieve. You see imports come crumbling down right into a contraction. They've now since rebounded a little bit, but they're starting to roll over. The dollar's looking to head higher again, and this is the issue, because what the dollar is telling us is the global economy is slowing. Because the issue about the dollar is you want to see the creation of money, and over long periods of time we actually do want to see the dollar weaken. And a lot of people don't understand that. They think, no, the dollar needs to be a store of value, but as the world's reserve currency, it actually needs to steadily weaken over time. That's what greases the wheel of the global economy. So what we're seeing right now from the dollar is a sign that the global economy is slowing. This is a problem because there's no evidence it's going to get better. And now you can see the impact it's going to have on consumers. Now there's a favorable impact in terms of it should bring inflation down. Let's go back to 2008. What do we see? The dollar spikes higher during the global financial crisis, and of course inflation goes right into deflation. But let's move to more normal times as we look to 2011. The dollar's rallying here. What happened? We see the disinflationary trend, and then it starts to put a lid on inflation. It puts it under control. And then around 2014, you see the dollar once again heads higher, and that brings inflation down into just a brief disinflationary trend. But now how about 2019? The dollar's rising again, puts a lid on inflation. Doesn't bring it down a lot, but at least it controls its direction. And now where we're at, we see everybody talking about how inflation is going to go higher, and what is the dollar telling us? Highly unlikely. So this doesn't make sense, because a higher dollar means less inflation. And for consumers, that should be a great thing. But there's something missing from this. We're going to take a deeper look, but something that you should not be missing out is some fantastic returns. We've been talking about all week our CTA Timer Pro product that we trade against the machines. As of close of business yesterday, we had 10 open trades, 9 are up. And look at these returns. You're talking nearly 10%, 12%, 5, and 9. These are all our current trades, with only one being down. Look, if you want to make money in the markets, if you want to do what our subscribers are doing, stay tuned to the end of the show. Check out the links in the description below. Be sure to use a coupon code, because Amazon CEO Andy Jassy has been on a cost-cutting campaign since late 2022. The company laid off more than 27,000 corporate employees that year and across 2023. Job cuts have continued last year and are now stretching into this year. And based on what we're seeing from the dollar, how it's crimping earnings and going to hit profits, it means companies are going to have to cut even more employees to remain competitive, to keep their stock price elevated. But as I said, why is this impacting the U.S. economy? Because a strong dollar, as you're about to see, is not that great for the U.S. labor market. As U.S. job growth slowed in January after a massive 2024 downward revision, but it wasn't as big as expected. The target number was 800,000. The actual number was just shy of 600,000. But what this tells us is the BLS's numbers are highly inaccurate. Now, why is that? Because payrolls used to be done at a local level. We had people actually doing the reports, but due to budget cuts, it got centralized in Washington years ago, and now the report's highly inaccurate to the tune of 600,000 jobs. But yet non-farm payrolls increased 143,000. That is, if you believe the number. We know that that's going to be downwardly revised at some point after upward revisions to the 2 prior months. Other revisions show that the government only carried out a once-a-year update, showed that job growth averaged 166,000, a slowdown from the initially reported 186,000 pace, meaning they're off by 20,000 a month, putting the headline number at around 120-some thousand for this month instead of the 143,000. The unemployment rate also came in at 4%, validating the Fed here. Now, that's what's really interesting about this, is the Fed's been looking for excuses to stay on pause, and they got it today. The unemployment rate has ticked down to 4%. Fed Chair Jerome Powell previously said, he said it's going to peak around 4.2. Well, so far from the moment it has. But how much longer? Well, we'll see. And while not directly comparable to prior months because of population adjustments, the BLS said excluding those effects, the rate fell from December. So saying the labor market is strong and robust, but the details suggest otherwise. Job growth in January was largely fueled by healthcare, retail, trade, and government. Of course, retail trade not big in terms of how much they pay, but look at what the impact was in high-paying jobs. Employment fell in mining, quarrying, and oil and gas extraction, as well as temporary help services and auto manufacturing. Now, what's interesting about temporary help, this is a great leading indicator, because when companies are expanding rapidly and the economy's booming, they like to bring in temporary help, put them on the payroll, and see if they work out. And if they do, they keep them. But if you start to see a decline in demand of temporary help, it is a major red flag. So we're seeing some indicators here as high-paying jobs are going to the wayside that the direction of the labor market isn't as good as the headline number suggests. It also had an effect on hours worked, and we talked about that yesterday being a big factor here, which dropped to the lowest since the onset of the pandemic. Meanwhile, hourly wages climbed 0.5% from December and up to 4.1% from a year ago. But let's look at what's going on here, because let's talk about production and non-supervisory employees. Here you can see in blue, average hourly earnings did tick higher, but they're not much higher than they've been over the last couple months. But look at hours worked. That plunged here to about where it was in 2024. We haven't seen such few hours, well, back since before we went into the pandemic. So we look at the trend here, we talk about why hours worked are such a good indicator, because what the payroll data is telling us is that employers are hiring. They're optimistic. They think things are going to turn around, but there's not enough new business and there's not enough existing business for all these people, so they're cutting hours across the board. If they continue to cut hours, the payroll growth in terms of average hourly earnings will not matter. It makes no difference if people are on the unemployment line. And let's take a look now how this impacts the inflation question, as the consumer price index now shown in blue against total incomes as we multiply average weekly hours times average hourly earnings of production and non-supervisory employees. And what we're seeing right here in this red circle is there's somewhat of a plateau of total incomes amidst the rise in inflation. And we've talked about here recently how the manufacturing sector and services sector are seeing rising input costs, and they intend and expect to pass it on to consumers. And what are we hearing from consumers right now? Confidence is absolutely plunging. We're going to get to that, meaning prices are too high. But what happens when we look back, when this situation happens, when incomes start to plateau and inflation rises? Well, you get right into the 1990s recession. It happened again around 2000. You start seeing incomes plateauing against rising inflation. You go right into a recession, and then the global financial crisis. And why this happens, it's the same reason. Because when you have rising inflation and stagnant incomes, it means people's dollar doesn't go as far. So the rising dollar here being an issue, we come again back to Amazon, what they're flagging here. Look, the rising dollar is a problem. It's a problem for more than one reason, because it also means that consumers can't afford as much. When they can't, that means they cut back their spending. That impacts other businesses, who eventually cut hours and cut jobs right into a recession. We see this trend happening each and every time. So now let's take a look at what this means for retail sales, because Amazon's warning wasn't just about the dollar. It's also about the consumer. They didn't want to say that. But look at real retail sales. This now in blue on a year-over-year rate of change against total incomes. And what do we see? When you go back to 2000, that plateau of incomes against rising inflation led to a slowdown in real retail sales. We saw the same effects in 2006. A plateau in incomes against higher inflation leads to slower real retail sales. And now everyone's been hoping that going to the holiday season, we saw real retail sales turn positive for a couple months, that this is going to be the beginning of a big surge in demand. And what when we see incomes and inflation, it tells us this is transitory. We're likely to see real retail sales head lower. So you start to get perspective. Amazon say it's about the dollar, but they don't want to admit it's about the consumer. And today, the University of Michigan said it is about the consumer, and in a big way. As U.S. consumer sentiment drops to 7-month low on price worries, remember, we told you this was likely to happen. We said this was coming, that consumer confidence would likely at some point adjust to the real economy. It's happening, and it's happening right now. Consumers expect prices to rise at an annual rate of 4.3% over the next year, up a full percentage point from the prior month. So this is a problem, because when we talk about incomes, and I wanted you to understand this, and in the rising dollar, consumers are saying, wait a minute, our wages are not going up here, but we see prices are going up. And what do you get in terms of response from households? That means they cut their spending. They realize, hey, we can't afford stuff, and the stuff we can't afford now is going to be even more expensive, so we need to cut our budgets. That's what you're seeing across the board here. And they saw costs rise at an annual rate of 3.3% over the next 5 to 10 years, up slightly from the previous month. So it now starts to make sense. Why are workers complaining about their wages? Because they're seeing prices go up, they're seeing their incomes not keep up with inflation, and this is not a good place for them and not good for the U.S. economy. But is inflation likely to go up as much as consumers think? Well, when we take a look at the consumer price index against U.S. regular all formations gas price, that's shown in red, both on a year-over-year rate of change. You can see the wonderful relationship between gasoline prices and inflation. If you're kind of wondering why President Trump wants the oil prices come down, because he wants gas prices to come down, and he knows if that happens, you get inflation down, and sure enough, gas prices, yes, on a year-over-year rate of change did rise here, suggesting that inflation likely to tick up a little bit more, but you'll notice it's not breaking out to the upside. Consumers perhaps panicking here a little bit, and the evidence is very clear. As we look at Michigan consumer expectations, this is looking out 6 months from now, we see that the last time they surveyed was 69.3, and it's now dropped to 67.3. So consumers are saying we're less optimistic about the future, and we're less optimistic about where we're at now. We were really excited here recently after the election, but now all of a sudden reality has set in that just because we have a new president doesn't mean it changes the economic fundamentals, and that brings, of course, consumer sentiment down as well to 67.8. These are dangerous signs, because when we look at real retail sales against consumer sentiment, when sentiment is going down, as you see here in red, what happens to real retail sales? They go down. You see it happen again very clearly here around 2007. Sentiment plunges, real retail sales plunge. Now we're seeing sentiment go down. What Amazon is saying, it's about the dollar. No, it's about the U.S. consumer, and they are indeed worried, particularly as they spend more on AI. And moreover, it's taking more time for the unemployed Americans to find a job, because it's really about the labor market, as consumers' expectations for their financial situation retreated in February to the lowest level since October of 2023 in the midst of higher inflation. So you start to get the big picture here. Everything is going the wrong direction. Now let's take a look at the University of Michigan Consumer Sentiment Survey, still shown in red against continued unemployment claims in blue. And now it starts to make sense. Consumers are raising the red flag. They're saying, look, the labor market's not going the right direction, and that means sentiment comes down, unemployment goes up. You see that happen each and every recession. What consumers are saying is the expectation that they're going to lose their job is going up. That means confidence comes down, and so too does the economy. So you start to see now what Amazon is warning about wasn't just about big tech. It's about the U.S. economy. It's about U.S. households. It's going to have a massive impact. But one thing that could change your household's budget is making money in the market. Let's take a look at our CTA Time Pro. Again, 10 open trades as of close of business yesterday. 9 are up, 90% win rate. And look at these returns. These are when the trades went on the books. You can see how great the report is, because what we do each and every day is we look at the machine positioning, and we look for periods where we see opportunities to get our subscribers in ahead of a big surge of machine buying. When that happens, you see big returns come from them. Then we try to tell them to get out before the machines cut and run. Here is our GDX trade we've been talking about. It's still heading higher. We told our subscribers to buy here, and now they're making money there, and you could too. And how do we do that? We look at machine positioning against a broad spectrum of equity, bond, currency, and commodity ETFs each and every day. Our report flags it. The best part is I look at every trade and tell you what I think. And that's how we have so much success. You get the daily report, you get the tradable signals, you get my opinion on the best trades. We back tested our data, we give you risk control levels. I even disclose how I'm trading my own reports. Plus, you grab a 30-day free trial. Use the links in the description below or the coupon code and start being on the winning side. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.